Now we're turning our attention to these adjunct accounts. Just like an adjunct account, it has to be tied to a parent account. Just like a contra account, it has to be tied to a parent account. And the only difference is the adjunct and its parent, unlike the contra, where the contra reduces its parent account, so that the credit balance in this contra asset account reduced the $90,000 debit balance to 85,000 when reported on a financial statement. Now the adjunct account actually increases the balance of its parent account. So you're not quite as familiar with these sorts of accounts. The only one that might be somewhat passing familiarity is a premium account. Premiums are recorded on any financial instrument that has a interest rate where the market rate of interest is actually greater than, the market rate of interest is less than the stated rate of interest offered by the financial instrument. You might have seen them in Principles of Financial Accounting in that respect. We're going to look at it a little bit more in Notes Receivable. Transportation in is another type that we'll look at in Intermediate 1, which is related to inventory. And there's also a security fair value adjustment account. That's adjunct account. It's adjunct to investment accounts. You'll be exposed to those in the practice problem. So just be aware of some of those common types adjunct accounts, and understand how they work. Now, remember that for the contra account, we had opposite balances. So for the contra asset account, allowance for doubtful accounts, we had credits increasing that contra account because debits increase the parent account. So we want the opposite effect for the contra account. Now, when we're talking about an adjunct account, the rules are aligned. So if we have a bond payable, which is a liability account, it is what we create when we have a creditor give us money. We're going to pay them back $100,000. So it's a liability. The premium to that then becomes an adjunct liability. We could have adjunct assets. Transportation in is an adjunct asset. If instead of a bond payable, this was a note receivable, our note receivable would be an asset, and any premium associated with that note receivable would be an adjunct asset account. And because we have the same balances, because we have both credit balances, the idea is that when we add these two together, they do add, and now they present us with what we would find on the balance sheet for this particular bond, which would be the $100,000 in the ledger account bonds payable plus the $10,000 in the ledger account premium on bonds payable, to give us the balance sheet value of $110,000. Remember that, again, what we're talking about is having separate information in ledgers, combining those accounts that are separate in our ledger to one account on a financial statement. So whenever a contra or an adjunct account, keeping those separate behind the scenes in the books, but when we present the information we're giving to the public, especially when we're talking about one of those financial statements, we combine to aggregate it and give the investors the simplest presentation possible. Excuse me. So that brings us out of step 2, out of the ledger. Now we're going to take all of those ledger balances and combine them to an unadjusted trial balance. So let's take, for example, just some made up transactions to a cash account. If we had journaled a number of cash transactions, which is very typical for cash, it is coming in and out of the company at a lot of points in time during the year. Maybe we started with a balance of $25. We added to that balance. We now have $5 more with the debit. Then we paid off some bills, causing us to credit it for $15. And then we took in some additional cash, we'll say $17. And we could keep going on, but this is enough for now. This would have all been posted in the ledger. When we're going from the second step, well, first, of course, it would have been posted debits and credits in a journal entry. We would then post those journal entry amounts to the ledger. Here's our ledger, keeping track of all the things that happen to cash regardless of when they happened. Remember, the general journal is a chronology. The ledger aggregates this information by account. We would have, in this case, 30.47 minus 15 would be $32. If this is at the end of whatever reporting period, we've accumulated all the general journal accounts, we posted all of it to the ledger, then this would now be my unadjusted trial balance number. So I want to take now, with the unadjusted trial balance, I'm taking just the final accumulation of all those debits and credits that were put to the ledger account and listing them. And you'll see that list on the following page. List is going to have an order. It's going to be ordered by assets first, then liabilities, then equity, then any nominal accounts. So remember, the nominal accounts are all income statement accounts plus dividends. Remember, dividends are not on the income statement. However, they are one type of nominal account. We also tend to further segregate assets. First, we list current assets, then we'll list any long-term investments, then we'll list any PP&E, then we'll list any intangibles. With liabilities, we separate those into current and long-term. Equity, we tend to have our direct investments first, so any of our stock accounts, and then our indirect investment, retained earnings. So there is a flow of how we want to list those accounts. Very important to remember when you're doing your practice problems. These unadjusted trial balances will have both nominal accounts recognized during the period. So nominal accounts are recognized both during the period and also as adjusting entries. They will be present on this listing. And then real accounts, of course, will also be there that we have during this period, as opposed to at the end of the period, which would start getting into adjusting entries. No adjusting entry accounts are reported on this balance. I list the ones that will not be on there. Basically, the adjusting entry expenses that are not going to be seen are depreciation expense, amortization expense, any estimations that occur at the end of a period. So, for example, we'll study later on, we'll talk about the allowance for doubtful accounts and bad debt expense. Bad debt expense would not find its way onto an unadjusted trial balance because it is an adjusting entry. So there's a lot of estimations that go into accounting information, and those will not belong on this particular sheet. Trial balances, any of them, whether they be unadjusted, adjusted, or post-closing, check only a mechanical accuracy of the posting process. It is a necessary but not sufficient condition to determine the accuracy of the process to this point, which means that it gives us some confidence but not certainty. So the way that I explain necessary and sufficient conditions is to say, if it rains, then that implies there are clouds. So what is the necessary and what is the sufficient? It is sufficient to say that if it's raining, then there are clouds. So clouds are a necessary condition for there to be rain, right? If it's raining, I know there's clouds in the sky because clouds are necessary for rain to fall. However, if there are just clouds in the sky, that does not mean it's raining, right? So we have a sufficient condition and a necessary condition. The equivalence of debits and credits. That is a necessary condition for accuracy. However, we do not know just because debits and credits are equal that will have an accurate trial balance. However, we do know that if everything is accurate, if we've done everything perfect, then we definitely know debits have to equal credits. So trial balances give us some confidence. It is necessary that debits equal credits for us to have accuracy, but it's not enough to say, oh, debits and credits are equal. I forgot to put that, not just debits and credits. If debits and credits are equal, then it's just one of the very necessary conditions for us to be accurate. So when will the trial balance fail to reveal an error? If a journal entry is omitted, right, we'll still have debits equal credits. We left something off, but if we left off a whole journal entry, then debits and credits could still equal. It's just that both of those totals will be too small. If we record that same journal entry twice, we have some kind of duplication going on. Debits and credits will still equal, but both totals will be too large. And we could just simply record the wrong accounts, but have 10,000 debited and 10,000 credited even to the wrong accounts. Well, individual account balances are going to be incorrect, but debits and credits still work, still are equal. So can be problems, but it gives us a little assurance that we're doing the right part, that we're doing the right thing here. No financial statements are prepared from account balances in this unadjusted trial balance. So we don't get any information. Make sure we say unadjusted, because there are some that are, we create an income statement from an adjusted trial balance. We create a balance sheet from a post-closing balance. Simply just a checkpoint before we go too far down the rabbit hole and start our step 4, which is adjusting entries. So here we got our unadjusted trial balance. It's at the year 12/31x0. These are always at a point in time. So, it's not over the year, because there is no over the year when we're talking about what are all of these guys coming to, right? Over the year, if we're talking about any account, we have a beginning balance that's at a point in time, and we have an ending balance that's also at a point in time. And then we just sort of consider all this that happens between those two as what happened during the year. So we're at a point in time, 12/31x0. Notice here that in this unadjusted trial balance, we have an order to the accounts, right? We have 3 current assets. These are all current assets. And then we move into PP&E assets, land, building, and equipment. And we also have PP&E contra accounts. So one of the very typical ways to create a trial balance is to have the contra accounts listed after the accounts that they're associated with. You could even bump it up so that it's building, and the very next one would be accumulated depreciation building. After that, we have a patent, and a patent is an intangible account. It's an intangible asset. So that is a different type, less liquid than PP&E. Then we have accounts payable. That starts us off on a current liability. Deferred or unearned revenue could be either current or long-term, depending on when we're going to fulfill that particular obligation from a prepayment of money that arose. Bonds payable are almost always long-term. So the placement on this trial balance tells us a little bit about what classification we have here. These accounts, common stock, additional paid-in capital. Here, of course, are our direct investments given directly from our shareholders. Retained earnings is an indirect investment. And after that, we have our nominal accounts. We have our nominal income statement accounts that were recorded during the period. And then finally, we have dividends, which is our final nominal account. But like I've said many times, It is not an income statement account. It is found on the statement of retained earnings, or more formally known as the statement of stockholders' equity. Notice, of course, we have an equivalency here in our balances. Debits equal credits at 1.4 million. You should always cap that off and make sure things are balanced. And also, when you're working through the practice problem, these are check figures that I give you. So I give you instructions to assignment one, check figures for your unadjusted trial balance, check figures for your adjustment, and check figures for your post-close, so that you know not only have you balance, you have now sufficiency because you know the right answer. In the real world, you won't have that. You won't have that right answer. You know that you might be accurate. And it seems like it's a necessary component of accuracy, right? Video will pick up on